Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. As we discussed in last week's podcast titled Investors in the Multiverse of Bearishness, simultaneous rise of various risks including high inflation, slowing growth, lingering virus, escalation in geopolitical tensions, and the central bank tightening has caused investors to experience heightened uncertainty, elevated cross-asset volatility, and weak market performances. On top of weak equity market performance, bonds lost value too, making it a challenging environment for multi-asset investors. At this juncture, we might be close to or even at the point of maximum pressure on financial markets, where a range of headwinds are all blowing at their maximum speed. Looking ahead, we should expect the headwinds to abate later in the year and provide the much needed relief for financial markets. However, this process is likely to be gradual and not a well-defined inflection point. Sequencing of abating headwinds will determine the speed and the nature of market performances looking ahead. But at any given point, markets may pay more attention to one particular risk over the others. Recent weeks have seen a strong shift of focus to the rising risk of a recession. This is reflected in falling prices of long-duration equities at a time of falling bond yields. Also, the performance of various risk assets has in general started to signal the recession obsession in the markets. No wonder the recession-related terms are trending on Google search trends. Defining a recession for a country is no easy task, let alone defining a global recession. For individual countries, some economists define a technical recession as 2 consecutive quarters of contraction in the gross domestic product. We prefer a more flexible definition widely accepted in the United States, where the National Bureau of Economic Research, NBER, defines a recession as a significant decline in economic activity that is spread across the economy and that lasts more than a few months. This allows the definition of a recession to be more flexible, inclusive, and impactful in terms of the depth, the breadth, and the duration. At a global scale, definitions become more difficult. The IMF and the World Bank prefer to characterize a global recession as a year in which the average global citizen experiences a drop in real income. This is also in line with another recession definition of output growth falling below the population growth. According to these definitions, 1975, 1982, 1991, 2009, and 2020 are the dates of previous 5 global recessions. The IMF and the World Bank have both recently downgraded their estimates for 2022, but both institutions still expect the global output to grow at least 3.5% this year. Of course, while further downgrades to these estimates are possible, the current expected level of growth is strong and much higher than the expected population growth. Now, let's take a quick stock of how some of the major economies around the globe are faring. Starting with the US, thanks to supply-side bottlenecks and the large fiscal stimulus of the past, inflation is still running well above the Fed's targeted level. This has increased concerns of a hard landing of the US economy as the Fed tightens rapidly to counter inflation. This has already caused some acute weakness in the US equity prices. Here, while we think a slowdown of the economic output is coming, we do not see significant economic losses in the US. Moving to the other side of the Atlantic, in the UK, Bank of England recently raised its projections for inflation while it marked down its growth estimates to indicate an output loss in 2023. However, the economic growth is expected to remain strong this year. IMF estimates are for a 3.7% growth for UK in 2022. In the Eurozone, which we think is in the most precarious position, most economies have suffered from rising fuel prices and from their geographical proximity to the war in Russia and Ukraine. With inflation far outpacing the growth in citizens' income, living standards have been hit, and this will in turn limit consumer spending and the recovery from the pandemic. Recent forecasts from the European Commission were scaled back sharply and imply stagnation in the second quarter of 2022. Let's move further to the east and to the world's second largest economy, China. Here, the recent lockdowns due to the zero-COVID policy have caused weakness in April economic output and triggered a range of downgrades from the economists and think tanks. We believe that the policy support in China will help avoid a hard landing of the economy. For instance, recently, China cut its 5-year loan prime rate by 15 basis points in a bid to help the rebound. Further, we know from the recent evidence that economic activity rebounds very sharply following the lifting of COVID-19 restrictions. Taking the rough with the smooth, while a recession is not a given, we think near-term financial market performances are likely to be driven by concerns about slower growth and rising risks of a recession. Investors should look at the global macro through a scenario-based approach. We define two scenarios. The base case scenario with higher probability sees an asynchronous mid-cycle slowdown of the global economy, and the worst case scenario with lower probability sees an outright recession. Thanks for listening. We hope you found this podcast useful. For more information on what was discussed on this podcast, please reach out to your ADCB relationship manager. You can also log on to our website at www.adcbam.com for more information. You were listening to the Global Investment Insights podcast brought to you by ADCB Asset Management, and my name is Kishore Muktinutalapati.